SoFi's third quarter 2024 earnings are just around the corner, and SoFi stock can definitely skyrocket on earnings before eventually, come crashing down again over the next couple of days, just as it usually does. I think for the average SoFi investor who you might be back holding for many years, hearing people tell you that, the fundamentals of this company is great, so you just have to hold on. But it doesn't feel that way because the rest of the market is going up, and the truth is that this is an opportunity cost. And going into these earnings, some of you might be wondering whether or not SoFi has become a broken stock, where the stock price is so far detached from the fundamentals of the company, and whether or not these earnings will actually make any difference. And for those of us following this company a little bit more closely, it could seem like there are some murmurings around these third quarter earnings that this time could potentially be a little bit different from usual. But as always, potential is a dangerous word, so let's dive in. Now, in my previous video, which I'm going to link over here, I basically talked about how member growth is going to be a key growth driver for SoFi moving forward. And we're going to look at how member growth actually affects the various parts of their business, especially how it is aligned with revenue and profitability. We're going to talk about, the different expectations of the different business segments that SoFi has, and why a swing in one particular metric can actually set SoFi up for a strong end to 2024. Now, a very quick disclaimer right now. I think I've tracked SoFi's metrics since they became a publicly traded company, but as their business grows, I think when I take my averages for my projections, right, I only tend to use data from the last 8 quarters, because when a company is small, I think especially when it comes to their percentages, right, some of these data can be quite skewed. So to me, this keeps my projections in line with the stature of the company. And so let's start with, the most important thing for SoFi, member growth. You can see their member growth has been around the mid 40% range over the last couple of quarters, but if you take a look at my own projections for the third quarter of this year, it shows around 36% member growth. Now, on the surface, that may actually seem quite bearish, but I think what you have to realize is that on the third quarter of 2023, that was the Taylor Swift quarter. So SoFi basically leveraged Taylor Swift's concert and in a way, kind of got quite a few of the Swifties to sign up as a SoFi member. So the member numbers in the third quarter of last year were quite inflated. And if you look at the App Store ranking and things like that, SoFi is still hovering around the 30s, so which is where they usually tend to hang out. And I'm not sure that we're going to see a huge influx in new members. And because, what I do to actually make the results more accurate is not just compare year-over-year numbers, but to compare the quarter-over-quarter numbers. And in the quarter-over-quarter trend, they tend to grow members by about 8%. And so by having a 36% year-over-year growth, it gets us to the 8% number quarter-over-quarter. So that means we can expect around 688,000 members. So of course, I hope member growth will come in, with a 7 handle. But I think that's possibly something that we can see in the fourth quarter of this year as they start to ramp up lending and their marketing efforts start to pay off. So I think for this quarter, let's make it a round number and say I'm expecting somewhere around 690,000 new members to be added. So I'm actually quite positive about member growth going forward. I think the Copa America just ended in July, so we may see some signups from there, but I'm not actually counting on it to affect the numbers materially because, seeing how they actually hosted only 2 games, if I'm not mistaken. But definitely what excites me about SoFi Stadium is in the next couple of years, they're going to be hosting things like the Olympics and the World Cup moving forward. And what actually makes me really positive about member growth is also the start of the NFL season in September, which will get more traffic to SoFi Stadium, the NBA season starting in October, and heading into January of 2025, we also have the start of the TGL, where SoFi is also a partner there. So I really like the way SoFi is using sports and positioning themselves basically in front of their target audience. And recently, they also partnered Venus Williams and Cameron Brink to launch their Give Her Credit campaign. And I think we'll see that start to pay off in the fourth quarter of 2024, going into the first quarter of 2025. And that brings us to their biggest revenue driver, but also a revenue driver that is, getting smaller by the quarter, not because it is actually slowing down, but other business segments are growing at a faster clip. Now, right now, their lending segment is actually only making up about 55% of their revenue. In the previous video, I actually talked about how their convertible note deal basically helped SoFi increase their capital ratios and put them in a stronger position to lend, and they could afford to add up to 2.9 to 3.3 billion in assets. So I'm going to link the video here for those of you who haven't watched it, but in general, their lending business has been pretty stable. Lending products basically grew in the mid 20% range in 2023, so around 24-25%. And coming into 2024, we can see that it's been hovering around the 20% range. And I expect the same cautious approach for SoFi going into the third quarter. So I expect lending products to grow by also around 20%. What I don't expect, however, is for lending revenue to actually slow down. I know they guided for lending revenue to be about 95% of 2023's revenue, but having beaten their own estimate in the last 2 quarters, right, they actually came in flat in for lending revenue in the first quarter and beat Q2 numbers by about 5.2%. They would actually need to see quite a substantial slowdown in lending revenue over the next 2 quarters in order to hit this 95% target. So if you take a look here, right, their lending revenue in the 2023 was about 1.33 billion. 95% of that will make it around 1.26 billion. So if you take out what they actually already made in the first and second quarter of this year, SoFi just needs an additional $605 million in lending revenue over the next 2 quarters. And so if you split that exactly in half, that means in Q3 and 4, we can expect about 302 million in lending revenue. That will be an 11 and 12% decrease respectively over the next 2 quarters. And in a rate cut cycle, I actually find it quite hard to say that that's a reasonable assumption. So, to me, the only risk here, why lending revenue will actually show a decrease, will be down to a recession, but I think that is more of a 2025 concern. So they have actually sold over $4 billion in loans in the last couple of quarters. They have improved their capital ratios and freed up capital as well. And all that's left is for them to execute. And so, however, with that being said, I don't actually think that we see the effects of the cuts so quickly, because in Q3, although we got the 50 BP cut that Anthony Noto was calling for, there was only 2 weeks left at the end of the third quarter. And so honestly, I don't think the 50 BP cut did much for them. And I think in addition, the mortgage rates in the US also rose after the cuts. So I think now it's at the place where, the engine is starting and things like that, but we're not off to the races yet. So expecting explosive lending growth in this quarter might be a little bit premature. But when it comes to lending, I think SoFi has shown with their Fortress deal in the last week or so, is their ability to diversify their lending revenue away from just originating loans to become a fee-based model, which eventually will give them a higher multiple, because that revenue source is not tied directly to the capital that they have on their book, so it will become a more robust form of revenue. However, I do think SoFi will still be cautious to close out the year, because if you look at macro, right, the backwards data have always been good. But I think, if I were to sum up how I feel SoFi is in terms of their standpoint and their outlook on the economy, it's, probably something like cautious optimism about the future, which is where I am at as well personally. I think pricing in a possible recession, but not a deep one that would fundamentally affect their business. Now, of course, if they wanted to, they can definitely try to blow analyst expectations out of the water. I think the problem or the worry is that if a recession hits and they actually do that, then they will actually find themselves in trouble. And so I feel like they're just biding their time. But with recent price movements, perhaps, sentiment is slowly changing. All in all, I think this aspect of their business has a lot of moving parts, but I do expect a low single-digit growth here, which is about a 3% growth in lending revenue and a 60% contribution margin. And so with that, that's about 352 million in lending revenue and 211 million contribution profit. Now, this business segment is one that actually I'm the most excited about currently. Guiding for an over 80% growth in financial services is actually pretty crazy, seeing how they actually plan to grow this at a 50% year-over-year rate. So this is actually growing at a much faster pace than I expected. When it comes to my own projections, I don't feel super comfortable projecting out anything more than 80%. Otherwise, the numbers really just get quite crazy to me. So what I'm going to do is I'm going to take their word for it, 80% year-over-year growth, and I'm going to give them a 1% premium over that, because I think, in general, they tend to beat their own estimations. So I'm just projecting out 81% year-over-year growth for financial services revenue, because they tend to over-deliver. But I think for me, the most exciting aspect of this business is actually the contribution profit and margin. Now, to be very fair, I wasn't actually fully paying attention to this particular aspect of their business when I was first investing in SoFi. You see, when I first invested in SoFi, right, I think my thought process was that it was the tech platform that will eventually be the one driving the growth, and financial services and lending will just be beneficiaries of their growth of their tech platform. Now, honestly, even though if I take that bias aside, right, this growth in their financial services is really, really exciting to me. If you look over the last 3 years, I think this segment of their business really demonstrates operating leverage. Now, for some context, right, in the third quarter of 2021, their financial services expenses are amounted up to about 4 times of their revenue. And what this actually means, right, is for them to make a $1 in revenue, they had to spend $4 of expenses. But over the last 3 years, their revenue, which is this green line that you see over here, has been growing exponentially. And you notice that since the third quarter of 2022, their expenses, which is the red line, basically stayed more or less constant. And I think this is largely down to the way that this segment of their business is operating. operated. And so for financial services, I think in SoFi's context, right, basically refers to things like their SoFi app, their credit card ecosystem, checking and savings accounts, and things like that. And so, all these things are products that actually incur initial cost to build up, but it's not like they have to spend more money to create a new app every time they onboard a new member onto the platform. So that's why the expenses can stay fixed or grow at a marginal rate compared to the rate of growth of their revenue. And so their expenses has been, within a plus minus, let's call it $10 to $20 million range over the last 8 quarters, while at the same time they're putting up insane revenue growth numbers year over year. Now, at this current quarter, they're expecting an 80% year over year growth, like I was saying. And remember how 3 years ago, they were spending $4 to make $1 of revenue? Now, as of the second quarter of 2024, they're actually spending only 69 cents to make the same $1 in revenue. And I think it's exciting for us to see where their financial services margins will level off. Now, this particular report that I got from NYU basically compiled the margins of different business segments. And when you look at the banking and the financial services segment, it shows that the financial services margin tend to be in around the 15% range, and banks tend to have a 30% margin. And so in SoFi's case, when you consider their financial services, I think there are some combination of banking services and non-banking services. So you might assume that their margin to be somewhere between the 15 to 30% range. But currently they're operating at 31% margin, and with them being a vertically integrated platform with Galileo and Technisys, I do expect them to be able to squeeze out even more margin going forward, and it wouldn't surprise me to actually see this margin going up and settling out around the mid 30% range, hopefully even leveling off closer to the 40% mark. So I think with an 81% year-over-year growth, I expect financial services revenue to come in at $214 million, and at a 31% contribution margin will give us $67 million in terms of contribution profits. Now, and then we come to their tech platform. I think personally, for me, I always wish that they were a little bit more upfront with the information about the tech platform, because right now it can be quite hard to value. Now, I actually realized that Galileo has a podcast, and I'll listen to it over the next couple of weeks to see what I can extract from their conversations and see how that actually applies to the current models I have. To me, this has always been, the most exciting part of the business, but at the same time, the most disappointing. I invested in SoFi because to me, they were a vertically integrated bank, and with the ability to use their tech stack to expand past the banking side of the business to onboard B2B customers. Now, in recent times, definitely the account growth is actually still quite strong in a healthy rate around the 20% range. However, the problem is that the corresponding revenue hasn't actually followed. And I know this, following companies like Palantir and things like that, that sometimes in the B2B sales, when you onboard the customers, the payment process or when you actually receive the payment from the customer is still some time down the road. And I think whatever the case may be, I hope for just more data points to be able to understand the business better and to apply a comparable multiple for this segment of their business. But I know Anthony Noto has been on TV recently to say that, they actually have a backlog of clients. So this segment of their business is safe even in a recession, and they are confident in achieving 20% plus growth in 2025. I know this might be old news. I just want to touch on this briefly with the bankruptcy of Synapse. I think the whole banking as a service sector is basically under the spotlight. And I think with increased regulations, right, certain banks, possibly start to back away from working with all these banking as a service providers due to the increased scrutiny from regulators and complexity. And I believe this is actually a plus for Galileo because they are already a subsidiary of SoFi, which is a nationally chartered bank, and so they are already under current regulations, or they're already working in line with current regulations. And so that means when companies actually use Galileo, they can be assured that their protocols will be aligned with current banking and financial regulation. And I think when it comes to their tech platform, I definitely expect them to at least meet their expectations. They're actually guided for mid to high teens growth. So I think the tech platform revenue should come in at around 18% growth. That puts us at around $106 million. And their margins have been pretty stable in the 30% range in the last couple of quarters. So I expect more of the same, which means $35 million in terms of their contribution profit. Now, if you put all of that together, let's compare my own projections versus SoFi's projections. I think my revenue projections came in at a total of about $673 million versus their high-end estimation of $645 million. So that's a 4.3% beat, which is, I think, around their average revenue beat over the last 8 quarters. Now, this is where it gets interesting. I think initially I wanted to keep their EBITDA number consistent in the 24 to 25% EBITDA margin range. So I used the 25% EBITDA growth, which is a 70% year-over-year growth. So this is actually still, a not too bad number. However, when you take a look versus their guidance of $165 million, right, that's actually only a 1.8% beat. Now, if you take a look at their EBITDA beat over the years, their lowest beat was a 10% beat, which is in Q1 of this year. And I'm just going out on a limb here and going to say that I don't think they're going to be performing 5 times worse than what they did in Q1 of this year. So, I'm going to increase the EBITDA margin to 27%, which is still within their guidance of 30%. And their EBITDA will come in at around 181 million. And so that means they will see a 85% year-over-year growth, which is, somewhere between the first and second quarter of this year in terms of growth rate. And it will beat EBITDA by about 10.1%, practically the same as the first quarter of this year, which seems fair to me. Now, I think definitely the hardest metric to project out is actually their GAAP net income, because we don't actually have enough data points over here, seeing that they actually only became profitable in the fourth quarter of last year. So if I were to take the average net income margin so far, that's around 7 to 8%, that will give me about 50 million in GAAP net income, a 12% beat in this upcoming quarter. And basically I have to weigh whether or not this 12% beat is realistic, seeing how they tend to beat their net income margins by about 70% in the last 2 quarters, even after you take out the convertible note. So if I were to use a 9% net income margin instead of a 7.5% net income margin, what you end up getting is a 60 million net income with an EPS of about 6 cents, even if you account for a 2% dilution, which is a 34% beat. And so in short, I'm actually happy with 50 million net income, 5% EPS, but not so secretly hoping that it actually comes in closer to the 60 million mark. And all of this is driven by member growth of 690,000. Now, if you remember at the start of the video, we actually talked about that one metric that can actually change the perception around SoFi and set it up for a strong end to 2024. And this is it. The third quarter of this year basically represents a full year of profitability. And what it means, it makes them investable for many funds and fund managers who actually look at profitability on a full year basis. So in the third quarter of 2023, right, SoFi actually wrote off over 240 million in goodwill for the purchase of Galileo and Technisys, and this was reflected as a $266 million loss in net income. So over the last 3 quarters, we always have this third quarter of 2023 acting as an anchor, weighing down SoFi's profitability overall. So previously, I think their full year net income was about a negative 172 million because they included the negative 266 million in the third quarter of last year. But once they announced third quarter 2024 results, if they come in at around a 50 to 60 million net income, their full year net income will end up being around 144 to 154 million dollars, a 300 million dollars swing up in net income. I think this, along with institutions starting to build out their positions in SoFi, with companies like Citigroup raising their price targets, I think maybe this time, you can actually go back to fair value around the $14 to $15 range and perhaps stay there for a while. But in all honesty, I don't really like to focus too much on price because I don't actually know whether or not it can go up to these price levels and whether or not it can even sustain these price levels moving forward. And it's just a fun exercise pre-earnings because I actually prefer to talk about the fundamentals of the company, why the company can achieve their long-term targets, which I cover in this video over here, and I'll see you in the next one.